And now it's time to bring in our next guest, a repeat friend of the income generation, and that's Harry Dent, author of 0 Hour and the editor of Economy and Markets newsletter, which is all available for free at harrydent.com. Harry, thanks so much for being back with us here on the Income Generation.
Yeah, good to be back, David.
So, Harry, it's so great to see you. The last time we were on the show together, we were both scratching our heads saying this thing is a bubble, what's going to happen? And now it's gotten even worse. More debt, more money today, MMT, they're printing up money through fiscal and monetary stimulus like no tomorrow. And so at some point, the Fed's going to taper. And what do you think is going to happen when that happens?
Well, we already got a taste of it. They tapered in 2018. And guess what? And they're acting like, oh, we're over the crisis now. We can pull back a little bit. I mean, they've been thinking that all along, by the way. They thought this stimulus was going to be temporary. We just had a temporary little crisis, and we just have to get over that cliff. And of course, they've been printing money nonstop for 12 years now. So the only time they did pull back was in 2018 and immediately had the repo crisis. So before COVID hit, they had to pump money back in strongly because the markets started to go down without daddy giving them more crack. And then COVID hit. Like, oh my God. I mean, COVID really was the ultimate trigger. But what they did was it was so strong that they just reacted, 10 times. I've calculated now, and I've got to up it again with the new 4.1 trillion infrastructure and social program instead of the 2.2 originally or whatever it was. But we're up to 55% of GDP since the repo crisis, the monetary surge, and now the even larger fiscal surge on top of it. 55% of GDP stimulus in a year and a half committed. I'm like, what are they going to do next? Are they going to do 100% GDP? Are they just going to print 20 trillion or build roads, a bridge over the Pacific?
Sure. Harry, the answer is yes. Yes, that's what they intend to do. So the answer is definitely yes. But listen, you're not afraid. You've never been one who's been afraid to stick your neck out and say, when do you think, what's going to be that point of capitulation? So how long can they keep pumping stimulants into the patient before eventually the patient crashes?
Yeah, that's right. They are just going to pump and pump and pump until it blows. This is a go until you blow. There is going to be no tapering. If they will quickly reverse that when they do, just like they did last time.
Can we get 5 more years out of it, though? Can we get that much time?
What's going to happen here is very, very, very simple. There's these people called the smart money, and they must be super smart. They haven't given up on this bubble yet. When they decide it's over, when they think, oh my God, okay, now we're at 40 times earnings, or the stock market, the Dow's now at 40,000 or whatever. Actually, I do have an upside target. I just looked at a long-term logarithmic plot of the S&P 500 in a channel that goes through the 1929 highs and the 2000 highs, the greatest bubbles, and goes through the biggest lows, the 32 lows, the 82 lows, 70 lows. The S&P could get to as high as 4740. Now, if we got up
4740,
wow. It's over.
That's a big number.
It's only 13% from here. But
Harry, we need to take a quick break. As soon as we come back, though, I want to talk to you more about that. And of course, what could get in the way of that, or how long it might take to get there. So, Harry, if you stay with us, that'd be great. And you stay with us too. We have much more coming up from Harry Dent right after the break. I'm David Scranton. I'm with Jeff Small, and you're with the Income Generation. We'll be right back.
Welcome back to the Income Generation. I'm Jeff Small, and I'm here with my co-host David Scranton and our very good friend and repeat guest, Harry Dent. Harry, we know that recently the Fed Chair, Jerome Powell, said the current path is unsustainable, but I never thought in a million years I'd hear you agree with Jim Cramer and say, buy this market. So tell us why you feel that way.
Well, no, I'm more like, you just kind of have to stick with it and be quick to get out because, what I do in my newsletter very seriously is I tell my subscribers when we are at a point where we could be peaking so people can kind of get prepared to move. And we are at one of those points. What I would be looking for here is the first sign that this thing may not get to 4,700, that high target, or may be ending, is that we break the trend line, the bottom trend line from the COVID low in March of last year. That hits about 4,000 on the S&P, so about 5% down from here. So if we break that, that's a wedge that's rising, and that would say, okay, we're at least likely to go into a correction. And then that correction, if it goes low enough, could turn into a top. So that's all I'm looking at. So I would be getting cautious if that happens. If that doesn't happen, then the trend is your friend. That this thing, literally the long-term resistance, the only resistance to this market that I can find from all the best charts is that 4740 target later this year, and that could be hit as early as late June. Let's say we have a minor correction here, like down to 4,000. If we turn back up and break the new highs after that, I would say, yeah, 4740 is a good target into June or July, something like that. And if it hits that, that's when I think the smart money will see the same thing I'm saying and say, okay, this is enough.
I was just going to,
because they're not going to stop. They're not going to stop printing.
I was just going to say that could happen really quickly. And you even said the end of June, which is very quick. So then, how low does it go? How low can it realistically go? Not your doomsday scenario, but maybe more of a consensus scenario from your analysis.
Yeah. The best target would be on that same chart. A more reasonable target, I would call it, because I think it could go lower. But the more reasonable target would be about 1,500 to 1,700 on the S&P. That would end up being, say, from 4,200 or 4,700, between about 64 to 68% correction. Now, I'll tell you one thing. That would have to assume that even if they lose control of this market and it does crash despite their best efforts to keep it up, that they'll still put enough goosing under it that it won't fall as much as it did in like 1929 to 32. But the 90-year cycle, the most powerful cycle in stocks, would suggest we're going to see an 80 to 90% correction. And that means the S&P could go to 600, 800, something like that. So that's a possibility. But I think that 1,700 target is more reasonable. And that's the same lows, a long-term trend line that went through 32, 74, and 82 lows. So those are the most extreme lows of the last century. So
and Harry, even
the best target.
Harry, even 1,500 was where we were in the year 2000. So, gosh, that takes us back a long way. Love to have you back sometime to talk to you about the long-term implications of all this money printing. Unfortunately, we don't have time to touch upon that today. Thanks so much for being back with us, Harry. As usual, it's our pleasure.
Okay, hey, we have a free weekly newsletter at harrydent.com. That's the way to get to know us.
Great. I love it. All right, Harry, thank you.